Welcome to Rivera-Gordimer's Summer CPE series. Each Wednesday this month, we will be diving into different topics to help you better understand your financial reporting. This week, we will focus in on nonprofits, diving into reading nonprofit financial statements as a board member and general board governance. If you have any questions during the presentation, please post your questions in the Q&A box, and we will try to respond throughout the presentation or directly with you afterwards. I'm Julie Davis, and I'm a shareholder here at Rivera-Gordimer & Company. I have over 15 years of experience in auditing nonprofits and government agencies, focusing in on compliance-related matters. I serve a wide range of nonprofit organizations, including substance abuse, mental health, homeless and housing, private educational institutions, affordable housing, child welfare, arts and cultural organizations, and many more. Outside of serving nonprofit clients, I also work with many closely held businesses and employee benefit plans. I currently serve as the treasurer for Leadership Tampa Bay and previously served as the board chair and treasurer for SPCA Florida. Stephanie, who will also be joining me shortly, is a senior manager who joined RGCO in 2022 with over 20 years of nonprofit auditing and consulting experience. Prior to joining Rivera-Gordimer, she worked with both a local and international auditing and consulting firm. She works closely with many different types of organizations, including HUD, substance abuse and mental health, affordable housing, child welfare, and many more. She also works with closely held businesses and rent-to-own clients, as well as employee benefit plans. She currently serves on the board of Clearwater Arts Alliance and is a volunteer with Clearwater Jazz Festival. Today we will start off with how to read nonprofit financial statements as a board member. Many board members are well versed in their own company's financial statements or have different perspectives based on their own unique backgrounds. But nonprofits have many unique items in their financial statements. We're going to focus today on some of those more unique areas and common items that you will see in nonprofit financial statements that maybe you won't see in your typical day-to-day financials. So, what financial statements do nonprofits have? They have many of the same statements, just with different names. For example, the statement of financial position is the balance sheet. The statement of activities and changes in net assets is the income statement and changes in owner's equity. The statement of cash flows, which is exactly the same, not very unique. And then there's also one new statement that you won't see, which is the statement of functional expenses. These four statements comprise the basic financial statements for nonprofits as required by GAAP. You most likely won't see all four of these as a board member, though, until the annual audit or review is done. Most monthly statements of boards include the statement of financial position and the statement of activities. The statement of activities is usually presented as a budgetary comparison as well, which is much more useful when you're making decisions throughout the year. So, let's dive into these basic financial statements a little bit more, starting with the statement of financial position. The balance sheet or statement of financial position has the same use as any company. It measures the assets, liabilities, and equity at a point in time. However, there are some unique items that can be included for a nonprofit. These are the most common items that you might see that are different. Pledges and bequest receivables. These are receivables just like a for-profit. However, the difference is that these are considered a promise to give and is not an exchange for service or product. These only get recorded if they are considered legally enforceable. So think of a signed contract or a pledge card, or even a copy of a trust or a will. These can be short-term, meaning you received the pledge and collected it relatively quickly, or it can be longer-term. An example of a longer term would be maybe receiving a $1 million pledge, but you will receive it over a 4-year period at $250,000 increments. Or a bequest receivable can be considered long-term as well. This could be that the donor who passed away set up a trust where a percentage is given out each year over a 10-year period. So recording these is important in being able to properly read and understand the nonprofit's financial position. If they aren't tracked appropriately, the organization could end up planning on relying on these funds, but they don't come in for a much longer period of time, which could lead to creating a large cash deficit. Another item you might also see is beneficial assets held by others. These are funds that are held within other organizations like community foundations. They are subject to spending policies that were set up when the funds were originally placed with the foundations. These may be within the organization's endowment funds or separate from an endowment fund that the organization may have. We see many organizations have more than one account held with other organizations for different purposes. Endowment funds, as I just mentioned, can include these assets that are held by others and can also be a separate investment account managed by a trustee. These are typically set up by the board or by donors and have restrictions on spending and availability. As you can tell, these items can be quite challenging to manage and understand. As a board member or someone who needs to rely on the financial statements, understanding the timing and availability of the resources is key and are great questions to ask if you are new to a nonprofit. Let's dive into some of these areas more, starting with endowment funds. Endowment funds are funds set aside by either the board or as a board-designated endowment or by a donor to help secure the future sustainability of an organization. The reporting on endowments can get a little complex as they have their own reporting requirements and are required to be tracked separately between board-designated and donor-restricted. And donor-restricted is even further broken into being tracked by perpetual donations and temporary. Perpetual donations are donations to the endowment fund that are perpetual in nature and that the principal cannot be used, only the earnings can be used. Now, temporary are time or purpose restricted. These can be used at any point in time based on the spending policy or the donor agreement. The easiest way to think of endowment funds are as a company within a company. These are reported on the organizational's balance sheet as investments or endowment funds, but have much more detailed information required to be reported in the disclosures between the different categories. A proper endowment fund will have a spending policy set up and investment objectives detailed out. Many financial advisors can assist with this process and guide you through the process of ensuring yours is set up appropriately. If you are new to a board, getting to know the endowment funds of the organizations, if they have any, will help you to understand what the intent was of past board members, the planning of the organization for future sustainability, and how much and when the funds are available for the organization for use. It's also important to know when you can draw upon the funds and when you can't. Most endowment funds are not available to the organization for general operating matters outside of the spending policy. Only that portion available annually is used to fund operations or for specific purposes. However, most endowment funds in their spending policies do have mechanisms in place for large draws in cases of large projects or in a financial emergency. If you encounter this during your time on a board, be sure you understand the policy and that proper approvals are obtained and documented. There are actually laws surrounding the setup of endowment funds and management of those funds called the Uniform Prudent Management of Institutional Funds Act, or as we like to call it, UPMIFA. As a board member, you do have a fiduciary responsibility to ensure that endowment funds are managed appropriately. Make sure to learn about how these funds are handled and if they are in line with your organization's policies. You can usually find a good summary of the policies and restrictions in the disclosures to the annual financial statements. Now, next, let's dive into net assets or equity for nonprofits. For nonprofits, equity is shown as net assets since the purpose of equity is to reinvest those funds back into the mission of the organization. Net assets is divided into with and without donor restrictions. Pretty simple to understand with that wording. However, proper reporting is key to be able to manage and honor donor intent. Having large amounts of equity and donor restricted isn't bad, but something that needs to be monitored. Many donors want to be sure that their money is actually being used as agreed to for your mission. While the statement of financial position may show a breakout of with and without donor restrictions, the disclosures to the financial statements will have much more information available to you. It will include what was used or what we call released during the year and for what the purposes of those uses are, as well as a breakdown of what's still remaining at the end of the year and what they are being held for. It's a great tool to understand if they are regularly meeting donor intent and monitoring those donor contributions. Donor restrictions do come in many forms. Permanent means that the donor wants the principal to be held in perpetuity, like we discussed previously with endowment funds. Temporary restrictions include both purpose and time restrictions. Purpose restrictions means that the funds were given to the organization for a specific purpose. These have to be more specific than your general mission, though. This could be a specific program or even a capital campaign or other items. Time restrictions are typically related to pledges or contributions to be received in future years. As you can see, nonprofits can have many items that restrict their financial position in the near term, which can make it difficult to manage. So let's look at some presentation options to help you better understand and monitor these. So here we show an unclassified statement of financial position. Looking at this, it would be hard to know how much resources are available in the short term, what liabilities are due in the short term, and what assets may be restricted. On the surface, the organization looks healthy. Large investments and even large net assets or equity. However, there's only about $250,000 in cash, and we don't know how liquid any of those investments are, and we don't know what portion of the notes payable that's included in liabilities needs to be repaid. That cash on top of normal accounts payable and accrued expenses can add up pretty quickly. As someone who's trying to make decisions in the best interest of the organization, requesting to have a classified statement of financial position is important for budgeting and planning on what may be available for spending. So next, let's look at what a classified version is for comparison. As you can see, assets and liabilities are now broken out between short-term and long-term, as well as net assets are broken down between with and without donor restrictions. You can now quickly and easily see what resources are available in the near term. This presentation now shows that only $175,000 of that $1.3 million of receivables is available within the next year, and that's assuming those payments come in on time. That's a large amount that you cannot necessarily count on from a cash flow perspective when planning and budgeting for operations. Also showing investments between short-term or maybe available per the spending policy versus in whole will show you what resources you have available. When you are working with an organization who has tight cash flow schedule, having this information would be key to monitoring their performance as well as monitoring to ensure the spending policy is being followed on the endowment funds. Also, if we look over at the liabilities, you're now able to see what your principal payments on notes are due within the next year. Again, another vital piece of information when you are planning and budgeting. If this information is not available on the annual statements, there is a disclosure required in the financial statements which show which assets are available to meet ongoing obligations within the next 12 months. This is called the liquidity and availability disclosure, and this will all provide you with similar information. Now, let's move on to that income statement. The income statement for nonprofits is called the Statement of Activities and Changes in Net Assets. Much like any good income statement, this will report the revenues and expenses as well as results of operations of the organization. Unique to nonprofits is the presentation of such information. The revenue should be split out and reported between with and without donor restrictions. Most organizations use a column approach, as we will see here. As you can see, the income statement can look a little different because of the requirement to report these separately. But if you look at the total column, this is the revenues for the organization as a whole. This would be a good indicator of monitoring how you are performing, as sometimes donor restrictions can vary year to year. Now, let's dive into some of these revenue differences. The majority of nonprofits follow the same revenue recognition standards as any for-profit company. There are a few organizations that are government-based and follow government accounting standards. However, that is not for us to cover today. General revenues that are listed on the Statement of Activities are sales-type revenues or fee-for-service revenues. These are recognized following the same standards as a for-profit industry. This would be sales of publications, fees for service, or maybe even clinic fees or other sales types of revenues. These should be shown as without donor restrictions, as they are considered an exchange-like transaction. Next are grants, which can be a little tricky. Sometimes grants are treated like a fee for service or on a reimbursement basis, while others are more contribution-based without significant deliverables. Many organizations track their grants different from government agencies, separate from private foundations. It's important to understand the timing of these grants and payments, as many are reimbursement based, meaning you have to use or spend the funds first before they pay you, which can cause a strain on the cash flows of an organization. It's important to also understand the timing of the grants and if they are renewable or one-time when thinking of sustainability of programs of the organization. Now, the grants that we discussed were more contribution-like. These can be reported as either with or without donor restrictions based on what the funds are to be used for. Now, contributions, this is where you'll see the largest difference. They have their own revenue recognition standards separate from a for-profit. These can be cash contributions received, promises to give in future periods, those pledges and bequests that we were talking about, or even in-kind donations. These are recognized only when they become unconditional. This is different than restricted. Conditions include things that the organization must do before it has a right to the funds, or if there is a right to return the funds. This is why grants that are on a reimbursement basis are not recognized as revenue until you expend the funds. In-kind donations for volunteers are only recorded if the organization would otherwise have to pay for the professional services. This would be donated professional time like marketing, accounting, legal, or other type of professionals. General volunteer time that is not specialized, think of cleaning the kennels, working in a thrift store, things of that nature, these do not get recorded. While these may be significant and a huge cost saving for the organization, standards say that they must provide a specialized skill to be recognized. Investment income is similar to the for-profit world as well. Realized and unrealized gains and losses are reported no different than any other entity. If there's a portion that is tied to an endowment, a portion or all can be reported as with donor restricted, following the intent of the donor. Lastly, the last unique item is there's a line item called net assets released from restrictions. This is where funds that were utilized during the year are released from their restrictions and taken out of with donor restrictions column and moved into without donor restrictions. This would be collection of pledges and bequests, use of donor restricted contributions, and other releases. This is how you will show the funds were utilized, not through the expenses, which we will dive in next. Expenses are shown differently for a nonprofit. They are shown at their functional level here, which means how they were spent between programs, management in general, and fundraising. This shows how the organization utilizes its funds for its programs. A key takeaway I always look for is what % of expenses are directly spent on programs. This is a quick and easy formula by taking the total program expenses and dividing it by total expenses. This is a great marketing tool as well as a great resource to go to donors with to tell them how much of every dollar is spent directly on helping your mission. While there is typically no set range, many organizations strive for above 70% of programmatic expenses. This can vary based on your organization type, and each organization is unique. You can easily look up comparables by using other 990s on GuideStar or other information available. If you need help calculating this for comparable industries, just ask your CPA for help. Now, if you are curious as to the natural classifications like salaries, occupancy, and those traditional expense line items, these are shown on the Statement of Functional Expense. Internal financial statements may not have the functional level like an annual statement is required to have. So monitoring the allocations and programmatic expenses throughout the year may be difficult unless you have an accounting system set up to track it at those levels. Many accounting systems have this capability, it just takes time to set it up. For monthly or quarterly monitoring of expenses, a better tool might be just to use a budget to actual report instead. So work with your team at your organization to determine which information is available or can be available to help monitor the financial health of your organization. The last area on the statement of activities and changes in net assets is the reporting of net income or loss, or as it's called in the nonprofit world, change in net assets. This will report your result of operations just like in the for-profit world. It is important to remember that being a nonprofit is only a tax status, not a business objective. It is okay to build up your net assets and have a for-profit each year. This is how you plan for sustainability into the future and for those rainy day funds. It's also okay to have some losses. You built up those reserves for use during times of need for the organization. When many organizations are first growing or expanding their programs, this comes at a loss at the start. While continued losses are not sustainable and need to be monitored, it is okay to have some losses. Think of it as using past funds to further the mission of the organization in the current year and in future years. Now, with that, I'm going to turn it over to Stephanie to talk more about board governance.
Thanks, Julie. Before we dive into some best practices for board governance, let's see if anything has really changed since before the pandemic, other than Zoom taking on a whole new meaning. I took a look at 2 different surveys conducted by 2 separate organizations, one that was conducted in 2019 and another that was recently released in 2024. First, in 2021, BoardSource released its 10th Leading with Intent study based on surveys that were completed in 2019. The survey included a population of nonprofits varying in size of revenues, geographic area, and mission. And the survey showed the following. Boards are best at understanding the mission of the organization, giving themselves an A- rating. They also listed the passion of the mission as the top priority for board recruitment at 98%. This survey also showed that both CEOs and board chairs rated finding people with the desired skill set as the most difficult. Close runners-ups included the following: finding individuals with community connections, finding individuals with fundraising experience, and the time commitment. As we will all see later on, all of these characteristics factor into finding that ideal board member. Boards and their CEOs also agree that fundraising is important, but that roughly 50% consider themselves not good at it at all. So keeping all of this in mind, let's fast forward to 2024. In February 2024, the Florida Nonprofit Alliance published the results of its 2023 survey. The survey identified the following as the top 5 resources that organizations needed to succeed going forward: funding, fundraising assistance, volunteers, board engagement, and capacity for effective community engagement. Does this all sound familiar? During 2023, approximately 42% said that the biggest challenge they faced was fundraising for programs and operations collectively. So what does this all mean? Challenges that existed before COVID still exist today and most likely will continue to exist. A strong, well-organized, and diverse board can be the key to an organization's continued success in overcoming some of these challenges. Today, we'll first go over some basic best practices for board governance and then dive into some of the specific challenges highlighted in these surveys. This includes board recruitment and engagement, fundraising and development, fiduciary responsibility and financial oversight, and finally, succession planning. First, let's talk about some general best practices. The good news is the basics really haven't changed. And this is not intended to be a complete list of best practices. It's intended to hit the highlights that we're going to cover today. To hit everything, we could easily make this into a much longer training. The basics include clarifying roles and responsibilities, develop and follow governance policies, recruit and orient board members effectively, establish clear strategic goals and monitoring mechanisms, regularly evaluate board performance, establish board committees such as the Finance Committee and Development Committee, and enhance communication and transparency, and stay informed and educated. Let's first look at some key policies and then tackle some financial oversight oversight topics later on. Every board in one form or another should have the following policies in place: Code of Ethics and Conduct, a conflict of interest policy, whistleblower policy, financial management policy, gift acceptance policy, and a social media policy. Most likely, most of these policies you already have in place. All policies should be reviewed on an annual basis and revised when necessary. One change with the gift acceptance policy you may want to consider is that you may want to update it to include cryptocurrency. Also, if you don't have a social media policy, you may want to consider implementing one. Your organization may already have one for employees that you can tailor for the board. So let's look at some things to consider when looking at a social media policy. First, you want to define the purpose of the policy and which platform it applies to. Next, and I know this seems a little silly, but clarify that board members are seen as an extension of the organization on social media. Separate the personal from the professional. Also, Emphasize the importance of keeping confidential information, just that, confidential. The policy should remind board members to respect the privacy of clients and donors, as well as stakeholders of the organization. Also, and this became more evident with the COVID pandemic, is crisis communication. If something does happen, such as a negative news story or other posting, clearly define who is the primary point of contact and who is responsible for responding to the public. Typically, this responsibility will fall to the board president or CEO, but in larger organizations, you may also have a communications officer. And finally, messaging. Make it easy for your board members to communicate your message. Encourage them to like or repost messages that have already been vetted and published by the organization. Next, in general, self-evaluation is one of the effective ways of looking at how you are doing. Perform a self-evaluation is important for identifying both successes and challenges as a board. Look for such checklists as this one that's on the IRS website. This checklist is used by the IRS to evaluate public charities and offers a sneak peek as to what they are specifically looking for with regarding to governance. I had a little fun with ChatGPT also, and I was able to create one in seconds, including a grading system. Now that you're organized and you have all these great policies in place, let's go find some new board members. First, what does the ideal board member look like to you? This may depend on what kind of board you're asking them to serve on. I put boards in one of two buckets. You are either a governance board or an operational board. Governance boards focus on oversight and accountability. They are removed from the day-to-day operations, and their primary focus is to support the CEO, provide oversight, and also support fundraising efforts. Operational boards are more directly involved in the day-to-day operations, are active volunteers, and are more common in smaller nonprofits. The time commitment for serving on an operational board can be much more significant. However, board members of both types of organizations have similar characteristics. Commitment to the mission. You want somebody that is passionate about your mission and dedicated to your cause. Fundraising skills. Money's important, right? Without funding, you can't meet the objectives of your mission. You want somebody ideally who is willing to and able to both personally contribute to your organization as well as being able to talk about your organization. Leadership skills and being a team player. I put these two together because you want individuals who can work together as a team, but at the same time have individuality and be able to organize your board in a positive manner. Also, commitment and time of resources. You want someone that is willing to give the time, treasure, and talent by attending meetings, participating in committees, and donating or cultivating donors to the cause. Let your board members be your treasure hunters. So, now that you know what you're looking for, where do you find these good board members? Network within your own board. I think this is probably your best resource, and sometimes we assume that if someone knows someone, they would have already made that introduction. But go ahead and ask your fellow board members who they know if you are trying to fill a specific skill set. Network within your own community. Chat up your donors. Ask staff about those longtime volunteers that may have retired and are already dedicated to your organization. Talk to community leaders at local events. Look and listen for that untapped resource. Finally, most boards I've sat on have some type of recruitment committee that actively look for new board members. This keeps the pipeline going, and it's a great tool for vetting new members and facilitating the onboarding process. Okay, so now you've snagged a board member. What's next? All organizations should have some kind of formal onboarding for each new board member. At this point, they should be already familiar with your organization and eager to help. Each board member should receive some type of welcome packet or documentation. It should include marketing materials for the organization, such as an annual report, pamphlets that you may use out in the community, or recent newsletters. First and foremost, you want your board members to be able to speak about the mission of the organization, both its successes and its needs. I would also include a copy of the strategic plan, if you have one, bylaws, and other key policies. Other information I would include is a meeting schedule for the year, because sometimes this changes, and board member contact information. Next, have that orientation on a one-on-one basis, but if you have more than one board member that you're bringing on at the same time, it's a good idea to do it as a group. It should include a tour of the organization's facilities if they haven't already taken one, discussion of specific current projects or initiatives, and an introduction to other key staff, not just the CEO or your development officer. Make sure you've introduced them to other members that work on the organization on a day-to-day basis and with the clients. Develop a mentorship or buddy system. Pair new board members with seasoned board members who can answer questions, help them navigate their roles and responsibilities as a board member. Every board is unique, and this is important particularly if you're trying to maintain an active succession plan for the board. Make them feel included, appreciated, and welcome. Lastly, give them a job. Put them to work. Introduce them to the committees that align with their interests and expertise. Notice I said their interests and expertise. I work with numbers all day long, but that doesn't necessarily mean I want to be on the finance committee. After you've recruited them, reeled them in, and given them a job, how do you keep them engaged? First, give them the opportunity to serve on different committees. It's easy to stick the CPA on the finance committee or the lawyer on the governance committee, but each year I would still do an interest survey and see how they're doing as a board member, and you might be surprised as what you discover. Next, I know that everybody's busy, but it's also important that there's ongoing training and seminars for board members. Sometimes this might look like asking them to come to a national conference where there is a specific track for board members. Other ways, this may look like a special meeting just to go over the strategic plan, and using a professional facilitator to foster participation by the board and to drive that important conversation. Finally, in-person interaction. I added this last one because in this post-pandemic world of Zooms and Teams, I think we've become almost too comfortable in meeting behind a screen. Yes, it's convenient, and yes, we're all guilty of it, but sometimes we're missing that important human interaction with our board members. At the last meeting of a board that I sit on, we actually had almost record in-person turnout because we had a couple of new board members and some in-person guests. An easy way to facilitate this informal discussion is to invite them to be a little bit early or stay a little bit late, and then that way they have a chance to talk to other board members in person. Next, fundraising and resource development is everybody's responsibility on the board, but it must be balanced with other board responsibilities in order to not lose sight of the mission as a whole. First, make sure that board members have a deep understanding of the board's mission. This understanding will help them communicate effectively with potential donors and supporters. Think of your board as your sales force for your organization. The best salespeople know their product and what they're selling. In this case, they're selling your organization and your mission to potential donors. Personal giving is important. Board members should lead by example through personal financial contributions to the extent that they are able. Donors are often more willing to contribute when they see that board members are personally invested in the organization. Identify and cultivate those donors. Let your board members be your treasure hunters. They can leverage their personal and professional networks to identify potential donors and cultivate relationships with them. This involves networking, attending events, and making personal connections. Make sure they have some compelling stories to tell. They should be able to articulate the impact of the nonprofit's work through compelling stories and examples. Board members can also advocate for the nonprofit's mission in their communities and raise awareness about its work. Donors are more likely to support causes that resonate emotionally with them and that they can identify with. Finally, be okay with evaluating and adjusting fundraising strategies in an effort to determine that it's working well. Look to see where improvements can be made. Board members should be willing to adapt and adjust strategies based on feedback and outcomes. Consider the path of least resistance. There's one thing that a CEO told me a long time ago that I've never forgotten. Sometimes it takes less effort to find a large donor than the effort it takes to put on a special event. Events are still important to keep your name out there and to engage the community, but sometimes the cost the organization takes in time to plan that event and execute that event goes unmeasured. Next, everybody's favorite topic, financial oversight. The key to financial oversight, I think, is reminding board members that they all have a fiduciary responsibility to the organization. It's easy to delegate this to the finance committee or audit committee, but the entire board is ultimately responsible. So what does it mean to have fiduciary responsibility? According to ChatGPT, our new dictionary, fiduciary responsibility refers to the legal and ethical obligation of an individual or entity, such as a board member, to act in the best interest of another party, typically a beneficiary or client. Board members have a fiduciary responsibility to ensure the organization's financial health and sustainability. This includes overseeing financial management, budgeting, fundraising strategies, and ensuring compliance with financial regulations. That's where the legal part comes in. So how do boards fulfill their fiduciary responsibility? Remember some of those policies we talked about at the beginning of this session? Make sure they're establishing clear financial policies and procedures, such as that investment policy or gift policy. Also engage in budget development and monitoring. Make sure you're reviewing and improving the budget annually and looking at performance throughout the year. And it's okay to adjust that budget during the year. If you add a program or if you happen to stop a program, I would retake a look at that budget and see if there's something that needs to be changed or modified going forward. And also, make sure you're reviewing and improving those financial statements and that you have an understanding of how the organization operates. Monitor cash flow and financial health. Have there been any unplanned expenditures? Are revenues being collected as they should? Most organizations will either have contributions, government funding, or a little bit of both. But if you're one of those organizations that depends on collections of Medicare or Medicaid or other health premiums, it's an important cash flow projection to look at to see what's going to ultimately be coming in the door. Educate your board about legal and regulatory requirements. What are the organization's filing requirements? Do they require an audit? If not, should you get an audit? And also make sure to review the information on the Form 990 at a high level. Make sure you understand and mitigate and have a plan to mitigate financial risks. This really came evident during COVID when some organizations, their contributions dried up just simply because of the downturn in the economy. Other organizations benefited from the pandemic because suddenly they had a lot of money to provide additional services. Establish those reserves for a rainy day. Also, you may want to look at diversifying revenue sources. I work with a musical festival, and during the pandemic, obviously, there was no music festival to be had. So we had to find other ways to bring in revenue. And that started with holding and asking sponsorships to do sponsorships for virtual concerts, which now we actually still hold, and it continues even though the pandemic has long been past. Educate board members on financial matters. Encourage them to ask questions of management. Encourage them to ask questions of the auditors. But make sure you're providing plain English information. They don't necessarily need to know how 2 + 2 = 4, But discuss with them, why did program fees go down? Or why did supplies go up? Is it hurricane season and we're buying more things to make sure that we're prepared? And also, finally, make sure that there's some financial performance metrics that you look at on a regular basis. Some of them can be as basic as budget versus actual, and are you staying on budget? Other might include looking at whether or not a program is self-sustaining by, are the revenues that are coming in enough to support the expenses that are going out? Another one that I like is the total serve versus total cost. How much does it cost you to serve an individual client? This is all important information to be able to communicate to your donors. Finally, succession planning. According to the Florida Nonprofits Alliance 2023 survey, the overall outlook of volunteers was positive and did present some ongoing challenges. The positive side of things. Volunteer absences have dropped 30% since the height of the pandemic. Over half of the nonprofits are using volunteers at the same or increased rates from 2019. But there are also some challenges that came out of this survey. 42% said that volunteers are the resource that they need the most, and 20% of current volunteers and board members are experiencing burnout. So how do we combat that last piece, the burnout? Succession planning for nonprofit boards simply means preparing for the future leadership needs of the organization. It involves identifying who might step up into important roles on the board, making sure you have those individuals on the board that are willing to do that. Do the current officers understand that they are part of a succession plan? You might get on the board and you might be vice chair for several years and not realize that you're part of the plan to be the next chair. And don't forget about your CPAs that are most likely your treasurers. They may also be interested in moving into a different leadership position. Also, recruitment and nominations. Do you have the members in place for a successful succession plan? If you don't have the members, do you need to go find the members that you can grow into those positions? So in order to wrap up our session for today, here are some key takeaways and best practices of an effective board. The following tools will help measure and enhance a board's effectiveness. Make sure you're reviewing policies annually and revise as needed. Regular board assessments. How are you doing as a board? Make sure that there's ongoing and training and development for your board members. And keeping up to date on the organization's mission and operations. Are there new programs that you can bring to the forefront to your board members? And also, finally, strengthening relationships with donors and stakeholders. Let your board members be your treasure hunters. The last couple of slides are some board resources that you can use on the internet. Blue Avocado is my favorite. It's a great website if you're looking for quick reads and has articles and free tools available on various topics, including board governance. Florida Nonprofit Alliance, you heard me mention their survey. They come out with a survey annually each year, and it's related to the status of the nonprofit sector in Florida. And then these last two, National Council of Nonprofits and Board Source, they focus more on advocacy for nonprofits as well as regulations. There are 3 more revenues in our summer series that you do not want to miss. July 17th, Audit Review and Compilation Overview and How to Produce Audit-Ready Financials. July 24th, Form 990 Highlights and How Watchdog Agencies Utilize them. And July 31st is our tax update.
Thank you for joining us today. Any questions not answered during the presentation, we will follow up with you individually. If you are registered for this session online, you will receive a CPE certificate within the next week. If you do not receive one, you can reach out to us at events@rgcocpa.com. Please join us next week as our Summer CPE series continues when Matt and Patrick walk us through what an audit, review, and compilation is and how to produce those audit-ready financials.